Yes, sir. Sir, very happy afternoon to all. Happy afternoon to all. Sir, we are going to start a brand new superb subject called as financial management. In this financial management, we have classified the subject into 5 categories. Number 1, part A is 2 analysis we are going to make. One is leverage analysis, number 2 is ratio analysis. Number 1 is leverage analysis, number 2 is basically we are going to analyze first. Then we will be learning about the cost of capital. Cost of capital. Then we are having capital structure theories and dividend decisions. Capital structure theories, and we are having capital budgeting and working capital management. These are the chapters available in financial management. The maximum chapters or all the chapters. This is the flow in which we will make the discussions. So the first discussion point is the leverage analysis. The first discussion point is that is the first chapter, one of the most easiest chapter available. That is why I am starting with the leverage analysis, my dear lovable students. With regard to leverage analysis, first, before I start with what is leverage analysis, we will understand about the income statement. We will understand about and what is leverage or how the leverage will work is what the discussion. Sir, for any concern, for any company, the income or the sales is very important. Revenue is what very important. Right, sir? In order to earn this revenue or sales, you have to incur the variable cost. You have to incur the... So your major income will be sales. In order to generate the sales, you have to incur the... Then what you are getting is called as contribution. What you are getting is called as... So I will make the sales. Sales is my revenue. From that, in order to make that sale, I have to incur the variable cost. Then balance profit available with me is called as the contribution. Is called as the... My dear lovable students, from that contribution, I have to pay my fixed cost. I have to pay my... The balance profit what is available with me is called as EBIT. Earnings before interest and tax. Earnings before interest and tax. So this is the flow of income. I will be making sales. In order to make the sales, I have to incur the variable cost. Then the balance profit available with me is called as contribution. My dear lovable students, from that contribution, I will pay off the fixed cost. The balance available with me is the earnings before interest and tax. Tell me, earnings before interest and tax. Comfortable? With this earnings before interest and tax, I will be paying to the debt holders. I will be paying to the debt holders, I will pay interest. To the debt holders, I will pay. So from the EBIT, I will pay first interest. I will pay first interest. Comfortable? The balance money available with me is called as earnings before tax. Earnings before tax. The second person, I will pay to the government. To the government, I will pay tax. To the government, I will pay. So from the earnings before tax, I will be paying tax at the applicable rate. I will be getting the profit after tax. Profit after tax. This profit after tax or PAT is what distributed to the preference shareholders and the equity shareholders of the company. Basically, this will be distributed to the owners of the company. Will be distributed to the such as preference shareholders and equity shareholders. Sir, preference shareholders we will pay preference dividend. And to equity shareholders we will pay equity dividend. Preference shareholders we will pay preference dividend. And equity shareholders we will pay. Sir, there is no confusion of how much interest I should pay. Whether I should pay 10% or 12% coupon rate will be recorded at the time of issue of the debt itself. When I issue the debt itself, I will say that it is a 10% debt. It is a 12% debt. When I issue the preference shares itself, I will be saying that 12% cumulative preference share capital or 5% cumulative preference share capital. Are you all really with me? So the return for the debt holders are fixed in nature. Return for the government are fixed in nature because they earlier itself say in the Finance Act that 30% is the tax rate, 20% is the tax rate, 10% is the tax rate. Are you all really with me? Or this guy is not liable to pay any tax, it is exempted from the tax. And preference shareholders also fixed. They will say that 10% is the return what we want. Are you all really with me? But this equity shareholders will not open their mouth. They are the real owners of the company. They will not express what they want. They will not say how much amount they want. Since that is the case, from the profit after tax, we will be paying what? Preference dividend. The remaining is called as residual earnings. What earning? What earning? From this residual earning, we will pay the equity dividend. We will pay the, that is a decision, sir, will be taken in the chapter of dividend. That is dividend decision. What decision? So, as a company, I may distribute the dividend, I may not distribute the dividend. It is my ishtam. If I need fund for the further project, I will not distribute dividend. If I don't have any project in my pipeline, entire residual earnings, what is available with me will be distributed as what? Dividend. Are you really with me? So it is my ishtam that I will be taken care in the chapter dividend decision. What decision? So in the face of the income statement, I will not talk about the dividend because I am having a separate chapter called as dividend decision. So here just I will be finding out number of equity shares, number of, I will be getting EPS called as earnings per share, earnings per share. So technically every organization will prepare such a statement called as income statement, which will basically say from sales to the EPS, sales to the, if you critically analyze this income statement from the sales to the EBIT, from the sales to the EBIT, this is one analysis. This is one analysis. Sir, from the EBIT to the EPS, this is analysis number 2. This is analysis number. And from sales to the EPS, this is analysis number 3. This is analysis number. So we can have 3 analysis, my dear lovable students. So analysis classified into how many category? 3 category. Number 1, analysis number 1, analysis number 2, analysis number 3. Getting it? Analysis number 1 is from sales to EBIT. Is from sales to. Analysis number 2 is EBIT to EPS. EBIT to. Analysis number 3 is from sales to EPS. Sales to EPS. Comfortable? Sir, this is sales and EBIT. This is EBIT and EPS. Comfortable? Basically, this is minus EBIT and this is plus EBIT. Will get cancelled. So basically, sales minus EPS is what our analysis number 3. Are you getting it? What the subject? Costing. Sir, you are FM teacher, sir? Yes, sir. What the subject costing is saying that cost should be classified into 2 categories. Cost should be classified into, one is variable cost, other is fixed cost. One is variable cost, other is based upon its nature. Based upon its nature. Before the introduction of this subject costing, we used to say that sales minus cost is equal to profit. This was the formula used in accounts. Then this subject costing got ego. He said that, for what purpose then I am here? I should say something, no? So I want to classify the cost into variable cost and so This equation has become sales minus variable cost is equal to contribution minus fixed cost is equal to profit. This is what the subject costing has made in the chapter variable costing, marginal costing, variable costing or marginal costing. Comfortable? Now our subject, which is FM, I don't want to call this as profit. I don't like it because it has been named by costing or accounts. I just want to call this profit as EBIT. EBIT, earnings before interest and tax. Earnings before interest and tax. What the subject costing has taken care is, if this is your balance sheet, surely not as per schedule 3, you will be having fixed assets and you will be having current asset. You will be having current liability and you will be having equity and liabilities. Correct, sir? Which comprises of equity share capital, which comprises of preference share capital, which comprises of debt. Are you all really with me? This part, which is nothing but current assets and what liability? Current liability. The study, in-depth study of current assets and what? Current liability is what? Net working capital. Is what? Net working, that we will be taking care in the working capital management. Are you all really with me? So the study of current asset and current liability is discussed in the working capital management. Comfortable? The study of fixed asset or PPE as per AS 10, what you have already studied, will be taken care in the capital budgeting. What budgeting? How much amount of fixed asset I should have is explained in the capital budgeting. Whether I have to purchase a fixed asset or not based upon the capital budgeting technique. Understanding? That's what budgeting? Capital. So capital budgeting will take care of the fixed asset decision, whereas working capital will take care of the current asset minus current liabilities decision. Getting it? My dear lovable students, in my capital structure, how much amount of equity should be there? How much amount of preference share capital should be there? How much amount of debt should be there? Whether my company should be a all equity company or my company should be a levered company. What company? Levered company. That means my company should have debt or not. In my what structure? Capital structure. Everything will be talking in the capital structure theories. Capital structure theories. Hello? Sir, tomorrow if I start a company, surely I need fund. I can raise the fund either by way of equity share capital or by way of preference share capital or by way of debt. Will you simply invest in my company without expecting any return? No, sir. You will surely be having some expectation. Why are you having expectation? Because if you are putting FD, you are getting interest. So you are sacrificing that return and you are investing in my company. So you will be expecting some return. Am I right, sir? So when I raise the fund, I have to pay you the return. It is a return to you, but it is a cost to me. It's a what to me? So it is what of capital? What of capital? So my dear lovable students, what this subject is saying that you will be having fixed asset. With this fixed asset, you will be doing production. Whatever goods you have produced, you will be sell. That's what? Sales. In order to make the sales, my dear lovable students, you have to incur the variable cost. You have to incur the variable cost. You will be having contribution. From the contribution, you will be incurring the fixed costs such as depreciation of the plant and machinery, such as factory rent, such as supervisor salary, such as any other fixed cost what you are incurring. The balance what you are having is the earnings before interest and tax. So the asset side of the balance sheet will generate EBIT. Asset side of the balance sheet will generate With that EBIT, you will pay to the liability side of the balance sheet. First, who gave you fund? Debenture holders. For them, you have to pay what? Interest. So from the EBIT, first you pay the interest. What is balance available? EBIT. When you see the capital structure, my dear lovable students, government will not be there in the capital structure. Is government there? They are sleeping partner. They are nominal partner. You can't see them, but you are running the business in India only. That means you are using the natural resources of government of India. Since you are using the natural resource of government of India, you have to pay some amount, 20%, 30% as per the budget, you have to pay to them. Correct? So, you have to pay what to them? Tax to them. The balance available is called as PAT. That PAT will be shared by the preference shareholders and the equity shareholders, basically owners of the company. But this preference shareholders is having certain preference. They are having two preference. One preference is to get the dividend. Other preference, at the time of liquidation, they are having the preference to get back the capital first. That is why they are called as. So only after payment of the preference dividend, you will make the payment to the equity shareholders. Comfortable? Are you all really with me? So, asset side of the balance sheet will generate what? EBIT, which is nothing but sales minus variable cost, contribution minus fixed cost, EBIT. So, this area from sales to EBIT, we will make one analysis number 1. Comfortable? Sir, whatever EBIT you have generated will be distributed to 4 people. 1 to the debt holder, other to the government, third to the preference shareholders, fourth to the equity shareholders. Who is the real owner of the company? Equity shareholders. This subject, financial management, is there only for the equity shareholders. Only for the. Sir, are you doing business to earn money to the government? No, sir. Why I have to pay tax to them? Correct? Sir, are you running business just to pay interest to the debt holder? Are you running business just to pay the preference shareholder? No, sir. Your intention is not to pay to them, but I am forced to pay to them. Without paying interest, I can't pay tax. Without paying tax, I can't pay to the preference shareholders. Without paying to these 3 people, equity shareholders cannot enjoy the money. So, in order to enjoy money by the what shareholder? Equity shareholders, I have to make interest payment, tax payment, preference dividend payment. Right, sir? So, this subject is concerned about how much money is earned by the equity shareholders. Our objective, financial management objective, is to increase the wealth of the equity shareholders. Increase the wealth of the equity shareholders. Are you really with me? So we just want to increase the wealth of the equity shareholders. None other than, sir, no other person like preference shareholders or the government. So we will be making an analysis from EBIT to what? EPS. That is what? Analysis number 2. And we'll be making analysis from sales to the EBIT, which is our analysis number 3. Hello, sir. So how many analysis we are going to make? Number 1, sales to EBIT. Number 2, EBIT to EPS. Number 3, shall we move into the first analysis, sir? The first analysis number 1 is between sales to EBIT. Sales to EBIT is saying that sales minus variable cost, contribution minus fixed cost, earnings before interest and tax. With me? Are you all really with me? So, my dear lovable students, what this subject is saying that? Very simple. For example, you are having 1 lakh rupees sale. Every concern should need sale. How much is the sale? If there is sale, there will be variable cost. There will be. Without variable cost, you can't generate sale, you can't create sale. Yes, sir. So if there is sale, you will be having I am assuming that I am incurring variable cost of 50,000 rupees. Only my assumption. Without calculator, can you say what is the contribution? 50,000 is the contribution. Fantastic to the core. Are you really with me? Sir, in order to run the business, since I have sales made, I would have either manufactured the goods or I would have traded the goods. Correct? If I am manufacturing the goods, I need factory. If I have traded the goods, I need the selling shop. Correct? For that, I have to pay rent. I have to incur electricity. I have to incur salesman salary. All these are fixed costs. Assume the fixed cost is how much? 25,000. So, without calculator, what is the EBIT? That's it. This is the first figures which I am giving. Basic data. I am just, sir, altering the case, my dear lovable students. Sir, you want to increase the sale in any business organization or decrease the sale? Increase the sale. Happy news. Sir, sales has been increased from 1 lakh to 2 lakh. Are you happy? Will the variable cost will be same 50,000 or different? Different, because when the sales increases, variable cost increases. When the sales decreases, variable cost decreases. This is what variable cost. It will vary along with the sales. That is why the name itself is variable cost. Variable cost. Correct? What variable cost will say to sales? If you move, I will also move. If you stop, I will also stop. If you come back, I will also come back. If you move forward, I will also move forward. This is what? Variable cost. Getting it? Sir, in order to make a sale of 1 lakh, how much variable cost I have incurred? That means 50% is the variable cost ratio. 50% is the? My dear lovable students, in order to make a sale of 2 lakh, what would be the variable cost? 1 lakh would be the variable cost. So the contribution is 1 lakh is the contribution. Getting it? You made a sale of 2 lakh. Wow, fantastic, very good, brilliant. So fixed cost. In order to make a sale of 1 lakh, I have incurred a fixed cost of 25,000. Yes, sir. So, in order to make a sale of 2 lakh, will I incur fixed cost of 50,000 or same 25,000? That is why it is called as fixed cost, because it will be fixed irrespective of the sale. So, it will be how much? 25,000. So 75,000 will be the EBIT. 75,000 will be the, getting it. From here, analysis number 1 is starting. From here, analysis number 1 is starting. This subject, our subject is making one analysis. Understand what the analysis logically. What this subject is saying that your sales was 1 lakh. Yes, sir. It has been raised to 2 lakh. Correct. Your variable cost was 50,000. It has been raised to 1 lakh. Your contribution was 50,000. It has been raised to 1 lakh. Clarity? Look at the change. Look at the change. What was the sales before? 1 lakh. What is the new sale? 2 lakhs. This subject is saying that percentage change in sales. What this subject is saying? They are going to make some analysis. What analysis they are making is percentage change in sales. Tell me. New sales minus old sales divided by old sales into 100. Tell me. New sales minus old sales divided by, what is the new sale? 2 lakh. Minus what is the old sale? Divided by what is the old sale? 1 lakh into 100. That means 1 lakh divided by 1 lakh into 100 comes to 100%. The subject is saying that there is a 100% increase in sales. There is a 1 lakh sales has become 2 lakh sales. There is a 100%. Any problem till now? Good analysis. They are saying that percentage change in variable cost. Percentage change in is equal to new variable cost minus old variable cost divided by old variable cost into 100. Comfortable? What is the new variable cost? 1 lakh minus old variable cost 50,000 divided by old variable cost 50,000 into 100. 50,000 divided by 50,000 into 100 is equal to 100 percentage. Getting it? This subject made a fantastic analysis that variable cost increased by 100 percentage. Happy? Sales increased by? Variable cost also increased by? It has to be like that only. It has to be like that only. Because if the sales increases, variable cost increases. Sales decreases, variable cost decreases. Hello, sir. If sales increase by 100%, variable cost should also increase by 100%. If sales decrease by 100%, variable cost should also decrease by 100%. Comfortable? Sir, this subject make an analysis of percentage change in contribution. Percentage change in? Can you contribute for the formula? Tell me. New contribution minus old contribution divided by old contribution into 100. What is the new contribution? What is that new contribution? 1 lakh is that new contribution. So 1 lakh minus old contribution 50,000 divided by 50,000 into 100. That means 50,000 divided by 50,000 into 100. Comfortable? Is equal to 100 percentage. How much percent? That means, my dear lovable students, here the subject said that, wow, there is a 100% increase in sale. There is a 100% increase in variable cost. There is a 100% increase in contribution. Everyone is traveling in the same direction. Yes, sir. Now the hero or villain is coming into picture. HAV laba, hero or villain. Yes, sir. Sir, what was the fixed cost earlier? 25,000. What is the fixed cost now? So, what is the percentage change in fixed cost? 0. There is no change in fixed cost. There is no change in. So, here we don't have any change in the fixed cost. Are you all really with me? Now, this subject is saying that percentage change in EBIT. Percentage change in? Can you contribute? Tell me. New EBIT minus old EBIT divided by old EBIT into 100. Comfortable? What is the new EBIT? 75,000 minus old EBIT. 25,000 divided by old EBIT. 25,000 into 100 comes to 50,000 divided by 25,000 into 100 comes to 200 percentage. Right, sir? So, to this sales variable cost contribution minus fixed cost, you will be getting the EBIT, which is how much percent? 200 percentage. This is like, wow. Because 100% sales increased. 100% variable cost increased. 100% contribution increased. Whereas 200% EBIT increased. Are you all really with me? Yes, sir. Are you all really with me? So, 100% increase in sale will lead to 200% increase in EBIT. Wow. Tell me. Wow. Tell me. That means, sir, if there is a change in sales, we are having more proportionate change in EBIT. Is it good or bad? Good, sir. Very good, sir. Because we put only 100% of the efforts. We should get only 100 mark in exam. But we are getting 200 mark. அதே சார் இப்ப ஞாபகப்படுத்திட்டு நல்லதான போயிட்டு இருக்கு. So my dear lovable students, if you put 100% of the effort, you should get only 100% of the return. But even though you are putting 100% of the effort, You are getting 200% of the return. Is it good or bad? Good. Very good. Very, very good. Correct? Now, this subject is introducing a alternate thinking. Now you tell me, this is what we have discussed till now. Sales minus variable cost, contribution minus fixed cost, EB8. Sales was 1 lakh, variable cost was 50,000, contribution was 50,000, 25,000 was the fixed cost, 25,000 was the EB80. This we call it as base. Comfortable? Alternate number 1, we change the data to how much lakh? 2 lakh. Minus 1 lakh, we will get 1 lakh as the contribution. Fixed cost was fixed at 25,000. You kept the EB80 as 75,000. Comfortable? You are very happy for the alternate number 1. Very, very happy, because of 100% increase in sales will lead to 200% increase in. Now coming to alternate number 2, danger signal with red color. Hello sir, sales has been reduced to 50,000. It's not increase, it is what? Decrease. Are you all really with me? Sir, variable cost will reduce. Yes sir, apada. Because when sales reduces, what should be the variable cost? 25,000. What should be the contribution? 25,000. What is the fixed cost? 25,000. What is the EB80? 0. That's it. Nakal hai. Gone. Are you all really with me? Sir, now percentage change in sales. Percentage change in. What is the new sale? 50,000 minus old sale. 1 lakh divided by old sale. 1 lakh into 100. 1 lakh into 100. Are you all really with me? Okay, man. So, 50,000 divided by 1 lakh into 100 comes to basically minus 50%, because there is a reduction in the sales. Hello? What was the old sale? 1 lakh into 50%, 50,000. So 1 lakh minus 50,000 is the new sale. Getting it? What is the percentage change in variable cost? Can we say new variable cost minus old variable cost divided by old variable cost into 100. So 25,000 minus 50,000 divided by 50,000 into 100. That means 25,000 divided by 50,000 into 100 comes to, I am happy because sales reduced by 50%, variable cost also reduced by 50%. Are you really with me? Comfortable? Now contribution, new contribution minus old contribution divided by old contribution into 100. Right, sir? Then 25,000 minus 50,000 divided by 50,000 into 100 comes to, I am happy. Are you really with me? There is no change for the what cost. What is the change in what IT? 0 minus 25,000 divided by 25,000 into 100 comes to, I am sad. Yes, sir. Because my sales drop only by 50%. Hello? My EB80 washed out by 100%. EB80 washed out by? When it was positive, you said that, wow. Now you will never say wow. Hello, sir? This measure the risk of the company. This measure the. So your sales may be either increase or decrease. Anything can happen. If the sales increases, it is a return. If the sales decreases, it is a risk. It is a what? Risk. When sales increases, it was a return. Because 100% increase in sale will lead to 200% increase in EB80. Are you really with me? Are you really with me? Whereas, if, sir, 50% reduction in sale will lead to 100% wash out in EB80. That is called as risk. So, your situation may be both what and what? Risk or, so this subject is calling both this word as leverage. What, man? This risk or return, just want to represent in one word called as leverage. What it is? For example, simple examples are on a road, a big rock is there. Big rock. You are walking through that road. You know that someone is going to get accident because of that rock. So being a very good heart person, what you are doing is you are going to take that rock and keep it aside. Are you really with me? What you will do, man? You will just take a stick or rod or some kambi. You will do like this and that's it. Game over. Hello, sir. Less effort, more return. Clear? Otherwise, you have to call 4 people. You will take 2 days leave also. Are you understanding what I am saying? So you are putting less effort, you are getting more effort. Because of that rod is called as lever. Are you really with me? That process is called as leverage. Are you really with me? So if the sales increases by 1%, the return is increasing by more than 1%. Or sales decreases by 1%, the return is, sir, wiping out more than. So this may be either risk or this may be either what? Based upon your company situation. If sales increases, we can say that positive leverage. If sales decreases, we can say that negative leverage. So leverage means it represents both what and what? Positive and. Are you really with me? Now this subject is coming to a conclusion that sales minus variable cost contribution minus fixed cost is EBIT. Inside this, we are having 2 costs. What are 2 costs? Variable cost and fixed cost. Are you really with me? In this, variable cost is moving along with the sales, whereas fixed cost is not moving at all. Are you really with me? So we are not having risk because of the variable cost. We are not having risk because of the variable cost. Because sales increases, variable cost increases. I don't have any problem. I will be happy to incur the variable cost. If sales decreases, variable cost decreases. I will be happy. My sales reduces. Sir, don't say that this is income part, sir. Sales can never be a risk. Correct. When sales increases, fixed cost is a blessing. Whereas, if the sales decreases, fixed cost like a villain. Hello? So, I am having risk because of the fixed cost. Because of the. For example, you are having a house, rented house. You have taken the house for rent. Every month, you have to pay 50 lakh rupees as rent. Can you peacefully sleep inside that house? No, sir. Because you'll be having a thought that when, sir, first day will come. Because on first of the next month, you have to pay 50 lakh. Hello? A person is sleeping on the railway station. Happily he will sleep because there is no rent. Correct? So if you are having huge fixed cost, it is a risk. If the sales what? Reduces. Getting it what I am talking to you. So what this subject is first saying that sales can never be a risk. EBIT can never be a risk because both are income. Either your variable cost may be a risk or fixed cost can be a risk. In that, variable cost is not a risk because we have analyzed. Because when the sales increases, variable cost increases. Sales decreases, variable cost decreases. Getting it? So the only risk is whom? Now this subject is asking why you are incurring the fixed cost. Why you are incurring the? I am incurring the fixed cost to operate my business. To operate my. If I am not operating business, why I have to take in this hall for rent? If I am not operating the business, why I have to incur the depreciation? If I am not operating the business, why I have to pay staff salary? If I am not operating the business, why I have to pay, sir, supervisor salary? Are you getting it? That means, my dear lovable students, because of dash my business, operating my business, I have to incur the fixed cost. Because of incurring the fixed cost, If the sales reduces, my EBIT is reducing more proportionately. More proportionately. This risk or return, whatever it may be, that you only know, I don't know, based upon situation to situation, is called as operating leverage. What leverage? Operating. So because of operating your business, you are incurring the fixed cost. Because of having fixed cost in the cost structure, because only two things are there in the cost structure. One is variable cost and, sir, I am having high variable cost. No problem. Hello, sir. Sir, I am having high fixed cost. Big problem. So because of having high fixed cost in the cost structure, not capital structure. What structure? Cost structure. Are you all really with me? You have to bear a risk. That risk or return is called as what leverage? So because of whom operating leverage is coming? Fixed. If there is no fixed cost, there is no what leverage at all? Operating leverage at all. Are you really with me? So we'll be start talking something about now. Sir, leverage, operating leverage. Sir, whatever examples I have given, I'll be repeating, be with me. Your sales is how much lakh? 2 lakh. Variable cost at how much percent? This is only assumed data, 50%. So from 2 lakh, 50% gone means how much lakh? What is the contribution? 1 lakh. Assume there is no fixed cost. There is no need that every business should have what? Fixed cost. Are you really with me? So your earnings before interest and tax will be how much lakh? 1 lakh. Sir, because of whom we will be having operating leverage? Here the company does not have what at all. If there is no what, there is no operating leverage at all. Are you really with me? That is why your what leverage? Operating leverage is showing it as one time. Is showing it as one time means my contribution is exactly equal to my EBIT. My contribution is exactly equal to my. There is no what cost at all. So when you are doing the answer, if you are getting exactly one, exactly, we can say that there is no what leverage. So the first lesson, lesson number 1, if there is no fixed cost, there is no operating leverage. If there is no operating leverage, there is no business risk. There is no, are you really with me? So in your cost structure, which is variable cost, and if you are having what cost, you will be, sir, having operating leverage. If you are having operating leverage, you will be having business risk. So what is the lesson number 1? If there is no fixed cost, no operating leverage. If there is no operating leverage, there is no Pakka. Sir, this is a very hypothetical situation because every business will be having. So we are going to talk about positive operating leverage. What? Sir, this is the first one, man. Operating leverage is equal to 1. If someone is coming and saying that my operating leverage is equal to 1, that indirectly shows that that business does not have fixed costs. They don't have operating leverage. Hence, they don't have. But every business will not work like that. Yes, sir. Every business will be having. So, assume sales as how much lakh? Variable cost at 50% comes to what is the contribution? Assume fixed cost to be what is the EBIT? Comfortable? Now the sales in year number 2 has been raised to how much lakh? Positive, negative? Positive. Here the leverage will work favorable to the organization. Because of having fixed cost, sir, the EBIT will multiply. Because once the sales increases, variable cost increases. Yes, sir. Whereas fixed cost will not increase. Because of the fixed cost in the capital structure, my dear lovable students, we will be having more returns as EBIT. Getting it? So what is the variable cost? 1,50,000. What is the contribution? 1,50,000. What is the fixed cost? 50,000. What is the EBIT? 1 lakh. So shall we calculate the operating leverage? Yes, sir. I am calculating the operating leverage. Listen, because of whom we are having operating leverage? So, sales minus variable cost, contribution minus fixed cost is EB8. If there is no fixed cost, there is no operating leverage. If there is no operating leverage, there is no business risk. Comfortable? So, what is above the fixed cost? Contribution. What is above, below the fixed cost? So, what leverage is equal to? What by what? Because sales, I don't have any risk. Even variable cost, I don't have any risk. So, this two part does not constitute any risk. Are you really with me? Because of whom I am having risk? Fixed cost. Who is above fixed cost? Who is below fixed cost? Are you really with me? Sir, what is the contribution here? 1 lakh. What is the EBIT here? So, my dear lovable students, listen very carefully. Sir, operating leverage is equal to contribution divided by EBIT. What is contribution? 1 lakh divided by EBIT. 50,000. So, 1 lakh divided by 50,000. 2 times. 2 times is the what leverage of this company? Of this? Sir, I am repeating once again. This is called as degree of operating leverage. What? If you go to doctor will say that you are having 105 degree fever, 100 degree fever, 98 degree fever, you don't have fever, please go. Like that, will he say, yeah? Yes, sir. So, same way, as a financial analyst, my dear lovable students, what we are going to see is degree of what leverage? Which is nothing but contribution divided by EBIT. What is the contribution? 1 lakh. What is the EBIT? 50,000. Is equal to how much time? If you get the answer as how much time? 2 time. It means 1% change in sales. Tell me. Will lead to 2% change in EBIT. Will lead to 2% change in. So if sales changes by how much percent? It may be either increase or decrease. Which may be either increase or, if 1% change in sales will lead to 2% change in EBIT. 2% change in? 2% change in? That is the interpretation of the 2 times. Getting it? My dear lovable students, let me ask you a question. What was your sale? It has become to. Can I find out the percentage change in sale? You are experts in that. So, percentage change in sales is equal to new sales minus old sales divided by old sales into 100. That means 3 lakh minus 2 lakh divided by 2 lakhs into 100. Comfortable? That means 1 lakh divided by 2 lakhs into 100 comes to how much percent? 50%. You just go here. What is the 2 lakh in 50%? 1 lakh. 2 lakh plus 1 lakh. That's a new sale. So the increase percentage change is how much percent? 50%. You are already having 2 lakh rupees sale. How much increased? 50%. What is the 50% of 2 lakh? 2 lakh plus 1 lakh. That is a new sale, 3 lakh. What is our formula? If 1% change in sale will lead to 2% change in EBIT. Correct? How much percent sales changed? So 50 into 2. 100% should be the change in EBIT. It is not the new EBIT. It is the. So the, sir, what EBIT is equal to? Old EBIT plus change in EBIT. Change in the EBIT. Hello. Always the old EBIT will be 100%. Always the old EBIT will be comfortable. What is the change? 100%. So 100 plus 100 will be 200% will be the new EBIT. Pakka? Okay, fine. Already question were having some sales. Yes, sir. Already question were having some minus variable cost. 1 lakh. What is the contribution? What is the fixed cost? What is the EBIT? Sir, can you carry these figures? Yes, sir. I am writing here, sir. Help me, sir. Sir, this is what your sales minus variable cost, contribution minus fixed cost, EBIT. What was the sale? Okay. What is the variable cost? 1 lakh. What is the contribution? 1 lakh. What is the fixed cost? 50,000. What is the EBIT? 50,000. With this base data, can you calculate operating leverage? Because in this cost structure, you are having fixed cost. If you are having fixed cost, you are having operating leverage. If you are having operating leverage, you are having business risk. Right? So, operating leverage is because of the fixed cost. So, what is the profit? Contribution divided by EBIT. What is the contribution? 1 lakh divided by 50,000 comes to 2 times. Do you have any interpretation of 2 times? If 1% change in sales will lead to 2% change in EBIT. Comfortable? In question, they said that 3 lakh rupees is the sale. Hello, sir. If 3 lakh rupees is the sale, is there any percentage change in sale? We already calculated. How much percent? So, 50% change in sale will lead to 100% change in EBIT. This 100% is not the new EBIT. So, the new EBIT will be old EBIT plus the change EBIT. Comfortable? Which is nothing but the old 100% plus the new change, which is in this case it is 100%. Every case it won't be 100%. So, it will be 200%. Are you really with me? What is the existing EBIT? 50,000. This is the old EBIT. This into how much percent? 200. Which is nothing but 100% old EBIT plus the increase is 100%. Getting it? So 50,000 into 200% comes to should be the what EBIT. So here I will be writing how much lakh? 1 lakh. Hello, sir. Now I am filling balance. What is the variable cost? 1,50,000. Getting it? What is the contribution? 1,50,000. What is the fixed cost? I got the EBIT as 1 lakh rupees. Are you all really with me what I am talking to you? So this subject is teaching me that if 1% change in sale will lead to how much percentage change in EBIT? How much percent change in EBIT? If 1% change in sale will lead to how much percentage change in EBIT? It may be 2 or it may be 5 or it may be 10. Are you all understanding? This study is called as operating leverage. This study is called as, are you really with me? Can you take this as year number 1? Can you take this as year number 2? You are having 2 period data. Always when you are having 2 period data, can I compare 2 year data? So, they are saying that degree of what leverage is equal to percentage change in EBIT divided by percentage change in sales. Because if 1% change in sale will lead to how much percentage change in EBIT is what our analysis. Are you really with me? Up a percentage change in EBIT. Percentage change in? You tell me what is the percentage change in what IT? EBIT is equal to 1 lakh minus 50,000 divided by 50,000 into 100 comes to 100%, my dear lovable students. Yes, sir. We already calculated percentage change in sale. How much? 50%, which is nothing but 3 lakh minus 2 lakh divided by 2 lakh into 100. Getting it? So you are having percentage formula. You are having what? Which is nothing but percentage change in EBIT divided by percentage change in sales. Getting it? What is the percentage change in EBIT? 100%. What is the percentage change in sale? 100 divided by 50. 2 times is the operating leverage. Are you all really with me? So in 2 ways, we are having 6 ways to find out what leverage alone. First of all, sir, we are making an analysis from what to what? Sales to EBIT. What is the problem? The subject is saying that when sales increases, variable cost increasing. When sales increases, contribution increasing. Or when sales decreases, variable cost decreasing. Or when sales decreases, sir, contribution decreasing. Sir, till now going in the same direction. But When the sales increases or decreases, one person is not at all reacting, not at all opening his mouth when I am taking class. Fixed cost. Are you all really with me? So because of fixed cost being constant, fixed, sir, I am sometimes having positive impact, sometimes having negative impact. If my sales increasing, wow, positive impact. If the sales decreasing, I will be having negative impact. So I can't explain, sir, positive operating leverage, negative operating leverage, like that and all. What the subject is saying that for both, I'm going to use a common word called as leverage, which will measure both risk and return. Are you really with me? If for you, if it is a risk, okay, fine. If it is a return, okay, fine. So inside the cost structure, inside your cost structure, if who and who is there, variable cost and fixed costs are there. Variable cost, no problem. Whereas fixed cost may create risk. That is the business risk. That is measured by way of operating leverage. Operating? When we are having fever, the doctor is saying that 0 degree, 10 degree, 5 degree. Are you really with me? So some measure should be there. For example, 10 kg, 5 liters. Like that, the risk should be measured. That risk will be measured by way of leverage. By way of what? Leverage. So, sir, for example, this much mangoes are there. Will you ask that how much liter of mango? No. How much? Kg of mango. Hello, sir. You are having Coca-Cola. Will you ask that how much kg of Coca-Cola? No. You will ask liters. The same way, we understood that in your cost structure, if fixed cost is there, it is a risk. It has to be measured, not in kg, not in liters, but in times. But in times. We got the answer as 2 times. What is the meaning of it? If 1% sales changes, not increases, not decreases, changes, 2% EBIT will change. 2%? I will typically add one situation for you. Sir, this is the year number 3. Your sales is become 50,000. Your sales, not 50, 75. We'll keep it as 75 better because fixed cost is 50,000. That's why. 75,000. Hello, sir. Yes, sir. What should be the variable cost? 37,500. Right, sir? Contribution should be 37,500. Sir, you don't not even having profit contribution to cover your what? Fixed cost. Getting it? So, I am raising the sales to 1 lakh. What was the original sale? 2 lakh. Now I have reduced to 1 lakh. Is there any change in sale? Positive change, negative change? Negative change. What is the operating leverage degree of your company? 2 times. What does it mean? 1% change in sales will lead to 2% change in EBIT. Comfortable? Sales changed. How much percent? How much percent? How you will find out? New sales minus old sales divided by old sales, 100. What is the new sale? 1 lakh divided by old sale. 2 lakhs divided by into 100. So 50% change. So if 1% change in sales will lead to 2% change in EBIT. So 50% change in sales will lead to 100% change in EBIT. Right, sir? So what is the 100% of 50,000? So 100% will come down. So 50,000 minus 50,000 should be, is it 0? Sir, is it 0? What should be the variable cost? 50,000. What is the contribution? Fixed cost will be fixed, 50,000. So the EBIT should be 0. Yes, sir. Sir, as you are costing, I am not traveling through sales minus variable cost, contribution minus fixed cost and all. Straight away, when you say a sales figure, I am saying an EBIT. Are you really with me? I am not filling the variable cost. I am not filling the contribution. I am not filling the fixed cost. Straight away, I am moving to the EBIT. That measure, that calculation is what leverage, man, which can be find out either by the formula method, which is, sir, degree of operating leverage is equal to contribution divided by EBIT. This is one way of finding out. This is direct formula. Or percentage change in EBIT divided by percentage change in sales. Percentage change in. Because my study is if 1% change in sales will lead to how much percentage change in 2% சொல்லாத. How much percentage change in? So if who changes, how much EBIT will change. So who should be the base? That's why in denominator I am writing sales. Some students will be having confusion. Sir, it is sales minus variable cost, contribution minus fixed cost, it is EBIT. No. So it should be percentage change in sales divided by percentage change in EBIT. No. What is my analysis? What is my study? If 1% change in sales will lead to how much percentage change in EBIT? So the base should be sales. So that's why the formula is percentage change in EBIT, percentage divided by, it is how much time? What are the conclusion? There is what cost? If there is fixed cost, you will be having. If there is operating leverage, we can say that business risk exists. Right, sir? So if there is positive leverage, here you are having positive leverage or negative leverage? Positive leverage. Why? Sales increases. Whenever sales increases, it is positive leverage. Whenever sales decreases, it is negative leverage. This company is having what leverage? Then sales is more than break-even point. Sales is more than. Sales is more than. That's why you are having EBIT. Because at the break-even point, no profit, no loss. Are you all really with me? So your company may have operating leverage is equal to 1. If someone is coming and say that my operating leverage is equal to 1, what analysis you will say? There is no fixed cost. There is no operating leverage. Hence there is no business risk. Right? If someone is coming and say that my company is having positive what? Leverage. If there is positive leverage means their sales has been increased. Yes, sir. And they are having fixed cost. Hence they are having operating leverage. Hence they are having, and their sales is more than break-even point. Sales is more than. Otherwise, you tell me, you will be making contribution divided by EBIT. Yes, sir. If your sales is not at all enough to cover the fixed cost, you won't have the positive EBIT. If you don't have the positive EBIT, numerator and denominator will not have the positive figure. Then you will be getting negative figure. Then how you will be getting positive EBIT? Sorry, positive leverage. If someone is coming and saying that my leverage is a positive leverage, they are having margin of safety. They are having. That means their sales are more than break-even point. Their sales are more than. Are you getting it? Yes, sir. Some people may come and say that my leverage are negative operating leverage. What? Sir, when I can say that negative operating leverage, what is my sale? 1 lakh. What is my variable cost? What is the contribution? What is my fixed cost? What is the EBIT? Negative 25,000. Negative. What is the formula for operating leverage? Contribution divided by EBIT. What is the contribution? What is the EBIT? Negative 25,000. Right, sir? So your leverage is minus 2. Leverage is what? This shows that high fixed cost. This company is suffering from high fixed. Negative what leverage? High what risk? Business risk. And negative operating leverage means sales is less than. Their sales are not even there to cover the fixed cost. They don't have margin of safety. They don't have. Their sales is less than break-even sales. Comfortable, sir? So someone will come and say that my company is having 1 operating leverage. Then what are the interpretation you will take? There is no fixed cost, no operating leverage, no business risk. Such business are very rare. Correct? Someone will come and say that I am having positive leverage. Wow! Because you are having fixed cost, you are having operating leverage, you are having business risk, and your sales are more than the break-even point. Comfortable? Someone may come and cry. My leverage is a negative leverage. That means you will be adding everywhere high sugar. What you will say? High fixed cost, Negative operating leverage, high business risk, your sales is less than the break-even point. Comfortable, sir? Sir, I'll be wind up with this man. Infinite or undefined operating leverage. Undefined? What is the sale? 2 lakhs. What is the variable cost? 1 lakh. What is the contribution? What is the fixed cost? What is the EBIT? What is the calculation? Degree of operating leverage is equal to contribution divided by EBIT, which is 1 lakh divided by 0. Anything divided by 0, you can't define that number. Still, section 35, research and development is going on. No number has been found out. Are you all really with me? So, this is what defined. So, someone is coming and saying that my operating leverage is undefined. Don't worry, I will define. Sir, fixed cost is equal to what? That means operating leverage is, business risk is infinite. Business risk is infinite. I cannot say this much is the business risk, because if 1 rupee sales down also, you may go to loss. Yes, sir. Because now you are in break-even point. There is no profit, no loss. Your exact contribution is equal to fixed cost. So I can't define what is your risk. Hello? So infinite or undefined operating leverage means sales is at this is the, sir, one line summary, man. Operating leverage and EBIT. If it is equal to 1, no fixed cost, no operating leverage, EBIT is equal to contribution. Comfortable? If it is positive, operating at a higher level than the break-even point, your EBIT should be positive. Comfortable? If it is negative, operating at lower than the break-even point, EBIT should be negative. If it is infinite or undefined, operating at break-even point, EBIT should be equal to, I am consolidating whatever we have talked till now. Just listen to me. Sir, this subject first drawn an income statement. Sales minus variable cost, contribution minus fixed cost, EBIT. From that EBIT, I have to pay the interest, I will be getting EBT. From that EBT, I have to pay the tax, I will be getting PAT. From that PAT, I have to pay the preference dividend, I will get the residual earnings. That will be shared by the equity shareholders, divided by number of equity shares will give the EPS. Now, we are making the study of the balance sheet item, which is from the sales and the EBIT. Right, sir? What is our study? You know, if 1% change in sales will lead to how much percent change in EBIT? Repeat. 1% change in sales will lead to how much percent change in EBIT? This is what operating leverage. Sir, why you are making such a study? What is the need of such a study? Because generally 1% change in sales will lead to 1% change in EBIT. No, that's what this study has been proved. Because if every characters are movable in nature, then 1% change in sales would have been 1% change in EBIT. But inside that, variable cost is changing according to sales, contribution is changing according to sales, but fixed cost is fixed. Because of that, EBIT is disproportionately changing. Are you getting the concept? So what this study is saying that, hence there is a need to study a situation of 1% change in sales will lead to how much percent change in EBIT. If fixed costs also having the nature or the character of changing according to what? Sales, we would not have studied this logic or the concept at all. Correct? So my dear lovable students, because of fixed costs there in the cost structure, we are having two structure. One is cost structure and the capital structure. One is cost structure and the cost structure is taken care by the costing, and the capital structure is taken care by the financial management. Are you all really with me? So in your cost structure, if you are having fixed cost, that will lead to a disproportionate income or expenses of the EBIT. Correct? So there is a need of study if 1% change in sales will lead to how much percentage change in EBIT. That word has been defined as leverage. What? Leverage. So who is not changing? Fixed cost. Why are you incurring fixed cost? Because of operating the business. So because of operating the business, you are incurring the fixed cost. So such a leverage is called as operating leverage. What leverage? So the reason for the operating leverage is the fixed cost. Reason for the operating leverage is the, alright sir. My dear lovable students, what is above fixed cost? Contribution. What is below fixed cost? So we can find out the operating leverage by contribution divided by EBIT. Getting it? Or we can find out the operating leverage by percentage change in EBIT divided by percentage change in, because this is a study of if 1% change in sale will lead to how much percentage change in getting it. Are you all really with me? After finding out this, some people will come and say that my operating leverage is exactly equal to 1. What are the things you will understand from that? There is no fixed cost, hence there is no operating leverage, hence there is no business risk. Comfortable? Someone may say that, sir, I got the result, my result is positive, I am having positive operating leverage. Then you will say that you are having fixed cost, that is why you are having positive, you are having operating leverage. That's why you are having business risk. Since you are having positive leverage, your sales is more than the break-even point. Comfortable? Because only a person whose sales is more than break-even point will be having positive leverage. Comfortable? Someone is coming and crying, saying that I don't have the positive leverage, I am having the... If that is the case, you have to add a high sugar to everything. You are having high fixed cost, that is why you are having negative operating leverage. Because of that, you are having high business risk. Sir, the negative operating leverage shows that your sales are less than the break-even point. You have not even touched the... But that guy is having margin of safety. But this guy does not have the margin of safety. Comfortable? Yes, sir. Sir, one person is saying that I am not able to find out the operating leverage because I got contribution divided by 0. Hello. So his answer is infinite. Hello, sir. If that is the case, infinite or undefinable, you have to say that fixed cost is equal to the contribution. That means your sales is exactly at a break-even point. Are you really with me? Are you really with me? Your sales is exactly at a break-even point. So I can't measure your what risk. Because you may go down or you may come up. Are you really with me? If you go down, you will become negative operating leverage. If you come up, you will become positive operating leverage. That's good for the company. Whereas negative operating leverage is not good for the company. It is very bad for the company. Comfortable? So sales minus variable cost contribution, you will be getting the minus fixed cost. You will be getting the study between sales and EBIT is what the operating leverage. One line summary of the entire discussion is if 1% change in will lead to how much percentage change in is what the operating leverage is all about. I am with you, sir. Till now, I am getting the introduction from your heart. Anybody is there? Where is a grand clap?